In October 2024, Li Auto's 1 millionth vehicle rolled off the production line. 13 months later, XPeng reached the same milestone. And in January 2026, NIO joined them. 3 startups, 3 million car factories, 3 companies that has survived a decade in the most competitive electric vehicle market on Earth. This should be the part where the story becomes simple. It doesn't, because after crossing 1 million vehicles, the company once known for making money saw its vehicle margin collapse. The company with the best headline margin was still losing heavily. And the company famous for burning cash suddenly came closest to breaking even. 1 million cars didn't settle the contest. It revealed 3 different ways a car company can still be fragile. 1 million vehicles proves a company can coordinate factories, suppliers, service networks, and customers at industrial scale. It does not prove pricing power, product breadth, or profit. That distinction matters in China because electric vehicles are no longer a niche. By late July, new energy vehicles represented roughly 2/3 of passenger car retail sales, but the market around them was weakening. Through the first half of 2026, the Chinese auto industry's profit margin was only 3.8%. And during the first 26 days of July, total passenger car retail sales were down 18% from a year earlier. So this is not simply a growth story anymore. It is a fight over who can turn scale into a durable business. The first quarter numbers make the contrast unusually clear. Li Auto delivered the most vehicles of the 3, but had the weakest vehicle margin. XPeng reported the highest overall gross margin, but its margin from selling cars was much lower. NIO nearly reached break-even, but did so with a heavy dependence on premium vehicles and a much leaner cost base. The same market is exposing a different weakness in each company. Li Auto used to have the cleanest story. Its range-extended SUVs were designed around families, large cabins, comfortable seats, screens, refrigerators, and no anxiety about finding a charger on a long trip. The formula worked. In 2023, Li Auto became the first of the trio to post a full-year profit. Competitors copied the formula. Meanwhile, Li Auto's first expensive battery electric model, the Mega, never became a second growth engine on the scale of the L series. Then came the i6, a smaller, lower-priced electric SUV. It gave Li Auto the volume breakthrough its electric lineup needed. In the first quarter of 2026, Li Auto delivered just over 95,000 vehicles. Yet, its vehicle margin fell from nearly 20% a year earlier to just 6.1%. The company swung to a net loss of roughly 2.3 billion yuan, about $330 million. That is the trap. Li Auto proved it could sell a mass-market electric SUV, but it had not yet proved it could sell one at the margins investors had come to expect from the company. Management itself pointed to the higher share of i6 deliveries, its purchase tax support, and the L series refresh cycle as reasons for the weaker margin. Li Auto's answer is to move upward again with renewed L series vehicles, more expensive battery electric models, and a much bigger story about embodied intelligence. But customers do not buy an abstract technology category. They buy a car that feels worth its price. Li Auto now has to recover pricing power without losing the customers it reached by moving down market. XPeng has almost the opposite problem. Its clearest identity has always been technology, driver assistance, vehicle software, electronic architecture, and now physical AI. That technology has external value. XPeng's partnership with Volkswagen has expanded into joint development and technology services, and that helps explain one of the strangest numbers in the trio's results. XPeng's overall gross margin in the first quarter was 20.6%, the highest of the three, but its vehicle margin was only 12.1%. The gap came from services and other revenue, which reached just over 2 billion yuan and carried a margin above 66%. XPeng says the year-on-year increase came partly from technical research and development services and parts sales. It does not disclose enough detail to call all of that Volkswagen income. But the effect is clear. Technology and service revenue made the company's headline margin look stronger than its car business alone. This may become a genuine second business model. But for an automaker, software revenue is still the side dish if vehicle demand weakens. XPeng delivered fewer than 63,000 vehicles in the first quarter, down one-third from a year earlier, and posted a net loss of roughly 1.8 billion yuan. The next quarter was much better. Deliveries rebounded above 103,000. The new GX flagship SUV also delivered more than 6,700 units in June. That is a promising start, not proof that XPeng has solved its premium problem. Its best-known volume products still sit below 200,000 yuan. That gives XPeng reach, but it also anchors the brand in a brutally crowded part of the market. The GX now has to show that early demand can survive beyond the launch window. AI also creates a pricing problem. The more XPeng spreads its best driver assistance features across affordable cars, the harder it becomes to reserve those features as the reason a premium model should cost much more. XPeng's challenge is to turn technical credibility into vehicle pricing power, not only licensing and service income. For years, NIO combined premium prices, premium service, and battery swapping with enormous spending. The products impressed people. The losses did not. But in the first quarter of 2026, the numbers changed sharply. NIO delivered more than 83,000 vehicles, almost double the previous year. Vehicle margin reached 18.8%, revenue more than doubled, and its company-level net loss narrowed to roughly 330 million yuan. The accounting line matters. Loss attributable to ordinary shareholders was close to 500 million yuan, while adjusted net income was slightly positive. NIO had also posted a small GAAP profit the previous quarter, but it had not reached stable profitability. Either way, NIO was much closer to break-even than it had been a year earlier. The turnaround had two engines. First, the new ES8, a premium SUV priced above 400,000 yuan, became a major volume and margin contributor. Second, NIO cut costs. Research spending fell from more than 3.1 billion yuan a year earlier to under 1.9 billion. Sales and administrative expenses also declined. That makes the improvement real but not automatically repeatable. NIO still needs enough volume to spread the cost of its service system, stores, and charging and swap network across more vehicles. Its lower-priced Onvo brand was created to provide that scale, but contributed only about 13,000 vehicles in the first quarter. Onvo then more than doubled its deliveries in the second quarter and stayed above 10,000 in July. Calling it a failure would be premature. The harder question is whether NIO can broaden volume without weakening the premium pricing that finally improved its margins. NIO's challenge is not just to sell more affordable cars. It is to make three brands support one expensive ecosystem. And here is the most important warning about reading any single quarter in China. By July, the delivery ranking had already changed. XPeng delivered just over 38,000 vehicles. NIO delivered nearly 36,000. Li Auto delivered about 30,000. That does not mean XPeng has won or that Li Auto is finished. July was a weak month for the wider market, and 1 month is not a business model. But it shows how quickly a product launch, a price change, or a supply constraint can rewrite the scoreboard. The three companies crossed the same milestone. They did not arrive at the same destination. Li Auto found that a volume breakthrough can crush margin. XPeng has valuable technology but still has to prove it can sustain premium pricing. NIO finally improved its margins but now needs more models and brands to support its expensive system. Their first million vehicles proved they could build cars at scale. The next test is harder, balancing volume, margin, brand, and technology at the same time, while the market keeps changing underneath them. That may be the real lesson of China's electric vehicle industry. There is no permanent survival line. 1 million cars does not buy safety. It only earns you a place in the next round